Hello, good morning, good evening, everyone around the world. How is everybody doing today? My name is Hendra Lau. You can call me Henry, and I'm the Senior Technical Analyst at elliottwavefocus.com. So today, I'm happy to meet all of you. We're going to do an introduction to Elliott Wave webinar, and this is suitable for beginner level. If you are new to Elliott Wave, we're going to talk about Elliott Wave structures as well as Fibonacci ratios, and also how to measure the waves within the structure to get the target. Okay, guys. Good morning, Cloud. So, is the audio and video all okay before we start? Audio, video is fine. All right. Thank you very much for the confirmation. Okay, guys. I will be doing this. Maybe the time is going to be around 1.5 hours, but I will try to do it a little bit faster. Okay, guys, because we got a lot of things to cover as well. All right, let's start it here. Okay, so this is what we call 4 building blocks of technical trading with our company EWF. Okay, so we provide Elliott Wave service. So we provide a forecast using Elliott Wave technique for 52 instruments right now, ranging from commodities, indices, and also Forex. And we think that for you to be able to trade successfully, really you need to understand these 4 building blocks. Right, so what we're going to cover today is only this part here, which is the Elliott Wave theory. Okay, and so the Elliott Wave theory is really just the basic idea about understanding what Elliott Wave is, how to read the structures, and also the Fibonacci and so on. But on top of that, if you want to trade successfully, you need to understand as well the cycle sequence correlation, which we are not going to cover it today. Also the risk management, how to open the right position size, how to make sure you have a trading journal before you enter the trade, and also how to use, you have to always plan your trade and then measure your risk before you enter any trade. So this is the risk management part, that any good trading system, whatever it is going to fail without the proper understanding of risk management. So this 4 building blocks is equally important. Not one of them is more important than the others. The fourth part is the trading execution. So this is the sort of the trading system. So a lot of people, our members included, okay, they sort of have a wrong understanding that if you see Elliott Wave charts, then you can start trading the charts, right? Then you can start trading the forecast based on the Elliott Wave charts. While in reality, guys, on top of the Elliott Wave charts, you need to have a trading system. And this is exactly the trading execution part. Our company has a trading system called the 3711 swing. It's based on the sequence, okay, swing sequence. And we use a specific method where we know exactly whether something is tradable or not, right? Just because the chart, for example, in the 1 hour or 4 hour chart is showing, let's say, S&P is going to rally, it doesn't mean that you can start buying it, right? So still, you need to understand all these 4 components combined, okay, before you can eventually understand exactly how to trade properly. Okay, so the trading execution here is really our own proprietary trading system. Okay, and we teach this to the members only because this is sort of proprietary here. So we provide the Elliott Wave forecast, but we also provide a lot of education. We have classes, we have mentoring one-to-one. And so if you are interested with the other aspect of this, I will give you some sort of resources. We have the classes, also the one-to-one mentoring over there, and also at the end, towards the end of the presentation, I'm going to give you a coupon code so that you can get some discount if you are interested to learn more. Okay. All right. So okay, some people complain there is no audio. Can someone please confirm to me if audio is okay? All right. So so I think for those that have a problem with the sound, it has to be your connection, because a lot of people tell me that they do not have any problem. Okay, if audio is off, this means it's on your side. Let me send the message first so that everybody knows. A lot of members, a lot of people say okay. All right. Okay guys, so towards the end of the presentation, I'm going to give you a coupon if you're interested to learn more about this. Now let's take a look here with the, so today we're going to talk about this aspect here in the Elliott Wave theory. Okay, so a little bit history here. Elliott Wave theory is a form of technical analysis to analyze financial market cycles and forecast the trends. It is named after Ralph Nelson Elliott, so he lives in 1871-1948. And he was inspired by the Dow theory. So the Dow theory is also a theory based on cycles, sort of basically what is the theory before the Elliott Wave theory, right? So the Dow theory is the basis of the Elliott Wave theory. I mean, Elliott later on make it a little bit better, okay, based on the Dow theory. But based on his observation on the Dow theory and also his observation throughout the nature, Elliott concluded that the movement of the stock market could be predicted by observing and identifying a repetitive pattern of waves. Okay, so very simply, Elliott noted from his observation that the movement in the direction of the trend is always in 5 waves, right? It's very simple. If it is with the trend, it is always in 5 waves. So it is labeled as 1, 2, 3, 4, 5. And this is also usually called motive wave, right? So motive wave is waves with the trend, right? Movement with the trend is called the motive waves, and usually it's 5 waves, right? And then the movement against the trend or counter trend is always in 3 waves, and this is called corrective wave. So basically it's only 2, either motive wave or corrective wave, right? Either with the trend or against the trend. If with the trend, it's 5 waves. If against the trend, then it's 3 waves. Okay? And the 3 waves is labeled as ABC. Okay? It's very simple. So if it is with the trend, then 1, 2, 3, 4, 5 is against the trend is ABC or WXY. But we're going to talk about it next. All right. So Elliott observed the fractal nature of waves. So this means smaller patterns can be identified within the bigger patterns. In this sense, Elliott waves are like a piece of broccoli, wherein the smaller piece, if broken off from the bigger piece, does in fact look like the big piece. This information, coupled with the Fibonacci relationship between the waves, offers the trader a level of anticipation and or prediction when searching for and identifying trading opportunities with solid reward to risk ratios. Now I included this picture of broccoli because picture usually is a lot better to understand. You notice here in the broccoli here, this is the big broccoli. If you peel off the part of the broccoli, so the smaller part of the broccoli, you will see that the smaller part itself resembles the bigger part, right? So in other words, it's the fractal nature of the waves. The waves, you can always split the waves, just like you're splitting or peeling off broccoli, and each time you peel it off, okay, then the smaller part is going to resemble exactly like the bigger part. So that's exactly what it means when Elliott says is the fractal nature of waves. And this is very important here because this is going to explain what is called the Elliott wave degree. Right, the Elliott wave degree, and how to read the Elliott wave is for you to understand this idea of the fractal nature of waves. So you can always subdivide waves just like you subdivide or peel off broccoli into smaller and smaller pieces, and each time the smaller piece is going to look exactly like the bigger piece. All right. Okay, guys, some of you complain about no video, but I really do think it's on your end, guys, right? Because I think many people also say it's fine. So right, okay, so it must be your internet connection. Unfortunately, I cannot do anything about it. We have a lot of people today, so but you know, our system and everything should be all right. So here is the famous 5 waves pattern. Okay, so you can see, I will explain to you. Now you notice on the left side is motive wave. Now if you remember, motive wave is movement with the trend, right? Movement with the trend. So it's always in 5 waves. You notice here 1, 2, 3, 4, 5 in the red degree, in the red label. You see 1, 2, 3, 4, 5 in the red. So movement with the trend, motive wave, always in 5 waves. Movement on the right side here against the trend is called corrective wave, right? So you can see label as A, B, C, always in 3 waves. Movement against the trend is 3 waves. Movement with the trend is 5 waves. So what about all this black label here? Now if you remember from our previous conversation about the fractal nature, peeling off broccoli, like I said, you can always subdivide every single wave into smaller waves. So that is what we call the fractal nature of waves, right? So wave 1, for example, in the red here, if you subdivide it, it will be, you will see another 5 waves inside the wave 1. So you subdivide, this is the internal of wave 1, you subdivide it, you will see 5 waves. So in other words, you see how this wave 1 here, this 5 waves in the black label, this itself, this smaller piece, is resembles the bigger piece, right? Resembles the bigger piece in the red degree. You guys understand? So that's what we call the fractal nature. So the smaller piece resembles exactly like the bigger piece. It's also 5 waves. And then you see how the wave 2 is subdivided into, because the wave 2 is nothing more than correction of the wave 1, right? So the wave 2 should be also in 3 waves because it's counter trend, corrective wave, so it's labeled as ABC. So you can see that this wave 2 subdivided into ABC. So this resembles this ABC in the bigger picture. So that's called the fractal nature. And then wave 3 in the red also is subdivided into 5 waves. Same thing with wave 4 is ABC. And then wave 5 also 5 waves. All right, so that's what we call the fractal natures. And then how about the ABC? Now the ABC here in the 3 waves correction, if you look into the internal, this is subdivided into 5 and then 3 and then 5. Okay, this is what we call a zigzag. If some of you are familiar with Elliott wave structures, ABC is called a zigzag. Internally, we should see a 5, 3, 5. Well, the 1, 2, 3, 4, 5 is simple. 1, 3, and 5 always is in 5 waves. 2 and 4 is always in 3 waves. All right. No, Juan, the Elliott wave is very specific technique. In fact, guys, Elliott wave is the most commonly used technique. I've seen reports from big banks like Goldman Sachs, Morgan Stanley, and all those big banks, and a lot of them are using Elliott wave. This tells me that Elliott wave is very common. I mean, they really use the Elliott wave. It's not really just some kind of theory that is not practical. It's very practical, but then you have to understand, like I said, that knowing Elliott wave doesn't mean you can trade it. It's two completely different things. Like I said earlier, you need to have still need to have a trading system that can let you know whether you can take the trade or not. Just because you see an Elliott wave chart, for example, is showing it will go up, it will go down, doesn't mean you can and then randomly trade it. Okay, you still have to have specific rules based on your trading system. Now, some of our members have their own trading system. They use harmonics or they use some other ways, you know, Ichimoku or some other ways. But for us, if you do not have a trading system, like our members, and also in the live trading room, every day we have a live trading room 7 a.m. Eastern time. We use this technique called the sequence 3711 to be able to identify whether something is tradable or not. But still, we need the Elliott wave chart because that will sort of it is like the map, right? Think about Elliott wave chart as the map and the path, and then you still need to know whether you can take the path or not. You can trade it or not based on specific roles. Okay, so this is sort of the very famous 5 waves pattern. 5 waves on the left side, motive waves, 3 waves down, ABC, corrective wave. So you only have 2, motive wave, corrective wave. Very simple. Okay. Now this is very, very important, guys. This is called the Elliott Wave degree. Okay. So Elliott basically originally in his book he identified this different degree 1, 2, 3, 4, 5, 6, 7, 8, 9. So 9 different degrees or cycles. Okay, and each one of them is labeled slightly different, right? This is our way to identify. So Elliott Wave degree is the Elliott Wave language to identify cycles so the analyst can identify position of a wave within the overall progress of the market. Now let's take a look back to our previous example here, the 5 waves pattern. You see this red label, for example, 1, 2, 3, 4, 5. If we compare it to this table here, that will be the minor degree, 1, 2, 3, 4, 5 in red color. Okay, that will be in the minor degree. And then you notice if I go back, the internal, okay, the internal of the 1, 2, 3, 4, 5, we label it as a black 1, 2, 3, 4, 5 with double bracket, right? And back to this table, you can see that is the minute degree, right? So based on this, you will know exactly how to read the charts because back to here, this means that the black here is 1 degree lower than the red. So in other words, this is the internal of the red degree, right? The red degree is minor degree, but the black degree is 1 degree lower than the red degree, which is the minute degree. Okay, and then if you really want to peel off again, like I said, every wave, if you insist, you can always peel it off again, subdivide it again. And guess what? If you subdivide this with 1 in black, what kind of subdivision you will get, guys? Any guess here? If you try to subdivide this into another lower degree, what kind of subdivision you will get? Yeah, we're going to talk about that later on, Angelo. So if you subdivide this with 1, guess what? You will see another 5 waves, right? Again, with 1 always is subdivided into 5 waves. So with 1 in black, if you want to subdivide this is going to be subdivided into another 5 waves, but then it's going to be a different degree. It's 1 lower degree than the black, and then you will use this minuet degree, which is the blue color. You understand, right? So very important for you to understand the Elliott Wave degree. This is one of the most important things. If you understand this different degree, lower degree, higher degree, and so on, then you will be able to understand and making sense of the chart, and you will be able to start reading the charts. Right? You notice here the blue 1 and 2. And why is this 1 and 2 in blue? Because you notice this blue color 1 is subdivided into 5 waves, right? Going back to this table, this is the blue one, intermediate. So you see back here, 1 with 1 in the blue intermediate degree is subdivided into 5 waves of minor degree, and then with 1 of the minor degree is subdivided into 5 waves of minute degree, and so on and so forth. So you keep subdividing it, and then you need to understand how to read the labels and how to label it properly if you want to label it yourself. If you want to, practice your own Elliott Wave, for example, you need to understand this. All right? So everybody understand about the degree, right? All right. So this is the new Elliott Wave for us today. Now, today's trading environment is far different than the one in the 1930s when Elliott Wave theory was first invented, right? Today we have computer algos, machines trading in seconds or milliseconds purely based on technical probabilities and statistics. So today we live in a very different trading environment compared to the past. Now, in today's environment, based on our observation, the biggest change, in our opinion, is in the definition of trend and counter trend move. So this is something that we do make several changes to Elliott Wave, right? We make it better, but this is one of the biggest sort of, you can call it, difference that we have at ElliottWave-Forecast.com. We observe in today's market, trends can move both in 3 waves and 5 waves. In other words, trend can move in corrective structures, and thus we believe that trends do not have to be in 5 waves. So if in the 1930s they say that trend always have to be 5 waves, if you don't see 5 waves, that is not a trend, right? The difference with today's environment is nowadays trend can move in 3 waves. So if I show it to you, an example, for example, you have 3 waves, 1, 2, 3, right? And then you have a reaction. You have another 3 waves up, okay? And then you have another reaction, and then let's say you have another 3 waves up. Now notice here, what is the trend, guys? If you look at it from this low to this high, is the trend bullish or bearish? If you look at it from this low to this high, it's bullish, right? It keeps making a new high, so it is bullish. But you notice here that there is really no 5 waves or impulse wave. Now we're going to talk about the rules of the impulse wave. So you cannot label this 1, 2, 3, 4, 5, for example. You cannot try, I mean, there's specific rules to label impulse wave or 5 waves. So right here, what we are saying is you can have an instrument keep going up or down in a corrective manner in a 3 waves. It doesn't have to be in 5 waves nowadays. So that is the biggest difference that we observe that make us special and different. All right, guys, let's go back here. So in other words, the motive wave, so that's why at Elliott Wave Forecast we prefer to call it motive sequence instead of motive wave, because we do think that motive waves do not really have to be in 5 nowadays. It can be in 3 and keep going higher or keep going lower, but they move in a, in a 3 waves all the time. Okay, so I will not have time to talk about a lot about Fibonacci, but I'm just going to, a lot of you probably are familiar with Fibonacci, right? Some of you, all of you are familiar with Fibonacci, know how to do it, right? I think most of you probably, if you are trading already, so you are familiar with Fibonacci, but I want to, yeah, I want to show you this Fibonacci ratio, okay? So we'll not talk about history and all those things, but you see Fibonacci is a sequence, right? It's a sequence of numbers starting with 1, 2, and then you keep adding the previous 2 numbers. So 1 and 2 you add becomes 3, and then the previous 2 numbers, 2 and 3, you add becomes 5. 3 and 5 becomes 8, 5 and 8 becomes 13. So you have this sequence of Fibonacci on the column here, and then in the row here you have the same sequence. At the numerator you have the same the Fibonacci sequence. In the denominator you have another Fibonacci sequence, the same sequence, 1, 2, 3, 5, and so on. And then if you divide the numerator and the denominator, you get a ratio. This is called Fibonacci ratio. So this is the table of the Fibonacci. So what is kind of interesting or important with this Fibonacci ratio is this is the Fibonacci ratio that you are all familiar with. For example, what is one ratio that you're familiar? For example, 1.618, right? 1.618 extension, or 0.618, for example, right? Notice here 0.618, for example. So how do you derive 0.618? It is usually always derived in a specific way. For example, this one, 0.618, I believe is you divide a Fibonacci number with another Fibonacci number, okay, that is 1 to the right side. I think that's how you get that 0.618. Let me double check here. 55 divided by 89. Yes, so if you divide 55 by the next number in the sequence by 89, you get 0.618, right? So same thing, you divide 34 by the next number, and 55, you get another 0.618. You notice here that the diagonally is all the same at 0.618 here. So that's how they come up with the Fibonacci ratio, okay? But you don't need to be concerned about this. I'm just telling you how they derive the Fibonacci ratio. The most important thing though is this. This is what you need to be aware of. This is the most important ratio, right? For retracement, you have 14.6%, 23.6%, 38.2%, 61.8%, 76.4%, and 85.4%. Nowadays, there is one other retracement level that is not Fibonacci, but also very important, also often used, which is 50%. So this is the typical ratio for retracement. You guys understand what retracement is, right? I mean, most of you are familiar. Retracement is when you have a move like this. Let's say you have a move, and then you want to see it retrace or corrects. So in the correction, is usually going to end in one of those Fibonacci ratios, depending on what kind of structure, right? Whether it's with 4 or with 3 or with B, things like that, then it will end in one of these ratios here. All right? And then extension, on the other hand, and this is a lot of people maybe are not familiar, this is also very important. Extension is for you to measure your target. Retracement is to measure correction. Extension is to measure a target. So going back to an example here, extension would be something like this. So if you have, let's say, an ABC, right? We look at ABC before, which is a 535. So let's say you have an ABC. So you want to know where the C is going to end on the way up. So you use the Fibonacci extension. So usually it's going to end around 100%, which means that this is going to be equal in length to this. So that's how you use the Fibonacci extension. So depending on your broker, okay, and your platform, I think all of the platform nowadays has a tool for you to measure Fibonacci extension. So I'm using eSignal, for example. I can measure Fibonacci extension very easily. So I can see, okay, 100%, 123.6%, and so on. If you use MT4, they also have a so-called Fibonacci expansion. Okay, so extension, this is the most important ratio. 100% is the most important. 100%, 123.6, 161.8% usually is for with 3 in an impulse. This 200 to 61.8, this one usually also in the with 3 of a a very strong impulse. It can go all the way to even, I think for Forex, I don't think Forex is ever going to go to 681, 6.81. This is usually for stock. But I think 161.8 is very typical for with 3, okay, in Forex. And then this 100%, 123.6% is the most common. By far is the most common, okay? And then 61.8%. So this is sort of the important ratios. We're going to have the recording for this, but not the slides. Okay, guys, we're going to post the recording in our website when it is done, or you can also email me if you cannot find it. Okay, let me give you my email. My email is that's my email. Okay, just in case you cannot find the recording if you want to review it. Okay. All right. So this is the most important ratios. Let's take a look again. All right, so now let's take a look at the structures, okay? Elliott Wave structures. So again, if you remember, we only have 2 different types of waves. One is the motive wave, another one is corrective wave. Motive wave is movement with the trends. Corrective wave is movement against the trend, right? Motive wave in traditional Elliott wave is always 5 waves. Corrective waves is always 3 waves. Okay? Fibonacci works in every time frame, Simons, whether 1 hour, 4 hour, 15 minutes, whatever it is, daily, weekly. Okay, we're gonna take a look at an example later on. You will understand it better. Okay, so motive wave. Now motive wave pretty much is 5 waves. It's very simple. There's a couple of variations of 5 waves, but all of them is 5 waves. right? This is also sometimes called impulse wave. Impulse wave is 5 waves, movement with the trend. So we look at it before here. So we have 1, 2, 3, 4, 5 in the red degree, minor degree, and subdivided into the smaller degree here. The subdivision here is in the I think it's the minute degree. The black here is the minute degree, if you remember the Elliott Wave degrees earlier, right? So this is the rules. Impulse wave subdivide into 5 waves, right? So you see 1 in the minor degree subdivide into 5 waves. So what we call an impulse is always subdivided into 5 waves. So over here, if you remember, there's also blue 1 here. So these 5 waves in the minor degree together form a wave 1 of a larger degree, intermediate degree, if you remember from this slide earlier, right? This wave 1 here, subdivided into 5. So this is the Elliott wave degree here. So impulse wave subdivide into 5 waves. Wave 1, 3, and 5 subwaves are themselves impulse. So you can see wave 1, 3, and 5 themselves are impulse, subdivided into impulse themselves. Wave 2 cannot retrace more than the beginning of wave 1. So wave 2 cannot be retracing more than the beginning of wave 1. Wave 3 cannot be in the shortest wave. So wave 3 here cannot be in the shortest wave in the impulse. Okay? Usually it's the longest wave, but sometimes wave 5 is the longest wave sometimes. But most of the time, I would say 80-90% of the time, wave 3 is the longest wave, but it cannot be in the shortest wave. Wave 4 cannot overlap with the price territory of wave 1. So you see the wave 4 here cannot overlap with the top of the wave 1. Okay? And then wave 5 needs to come with momentum divergence, meaning you can look at the RSI, okay, RSI indicator, and you need to see a divergence in the RSI. So this is the rules for you to be able to label this as a 5 waves move. If you don't follow the rules, if one of these rules is not met, then you cannot label it as impulse. All right? So very important. If one of these rules is not met, then you cannot label it as 1, 2, 3, 4, 5. It is recorded that, yes. Wave 3 and 5, you mean the length? The wave 3 usually is the biggest, the longest. It's usually subdivided into 5 waves, Mahes. Okay? Now, what about the Fibonacci relationship? Wave 2 is between 50%, 61.8%, 76.4%, or 85.4% of wave 1. Right? So cannot retrace more than wave 1. Most of the time, I would say between 50% and 76.4%. So it's always an area, guys. When you try to buy, for example, you cannot assume that it will touch 50% retracement and then immediately will go up. It doesn't happen that way. You should always think of trading as an area, and that's why very important for you to calculate your position size so that you can survive the trade, right? You have to allow yourself, for example, to give yourself room to make the trade successful by calculating the right size, position size when you are trading. So it's always a range. I would say, I mean, most of the time it's between 50 and 61.8. I would say 80% of the time is between this 50 and 61.8% from the wave 2. Wave 3 is typically 161.8% of wave 1. So in other words, this is 1.618 of this. Okay? So if I go here, so let's say if I have wave 1, wave 2, wave 3 is usually the longest and go past. So if I measure the Fibonacci extension, now this is equal leg 100%. This is where this leg is equal to this. Wave 3 is always, most of the time, is 1.618, 161.8%. Always, usually is the longest wave. Okay, typically is 161.8%, but also can be more than that, can be 200 and so on and so forth. Wave 4 typically is between 23.6, 14.6%, 23.6, 38.2% of wave 3. So the retracement here typically is around, I would say 80% of the time is between 23.6 and 38.2%. Okay, but no more than 50%. So this is an additional rule that we add in at elliottwave-forecast.com, right? We add the idea that this wave 4 cannot retrace too big, okay, and more than 50% of the wave 3, because otherwise it will become, you know, it will become too big for a retracement, and it could end this cycle. Instead of getting wave 5, we can in fact get a turn instead. Okay, so this is a sort of an additional rule, no more than 50% of the wave 3. And then wave 5 here, there is a recording, Christopher, yes. Wave 5 usually is going to be equal to wave 1, okay, or 61. I mean, by far the most common target is wave 5 equal wave 1. And then another way to calculate is 61.8% of wave 1 to 3. Another way is using external retracement 123.6%, 161.8% of wave 4. So I don't think we need to really look at this, but I think for our purpose, this is the most sort of common, wave 5 equal to wave 1. Okay? Now let's take a look at an example of impulse wave. Here's the pound yen 1 hour chart. Okay, I erase some of the labels because otherwise, you know, you will know the bias. But you notice here, from this peak we have 1, 2, 3, 4, 5. Right? 1, 2, 3, 4, 5. Impulse. 1, 2, 3, 4, 5. And again, here this is the roll subdivided into 5 waves and so on. You notice here that wave 3 is the longest one, right? The longest one, typical of impulse. Now we do not see the internal of this, but this looks like a diagonal here. We're going to talk about diagonal, which is 5 waves. And then, so all of this wave 3 also should be subdivided into 5 waves. This is also subdivided into 5 waves. And then wave 4 cannot overlap with wave 1. You notice here wave 4 is not overlapping. It's very sort of shallow bounce, which is typical of impulse. And then wave 5 needs to come with momentum divergence. So if you look at the RSI, this is the RSI in the bottom here. You notice here that the price makes a new low, but the RSI makes a higher low, right? The price makes a lower low, but the RSI makes a higher low. So that's what we call momentum divergence. So this is the rules for you to label it as impulse, and this is an example in the pound yen. Okay guys, because I have limited time, I may not be able to answer all of your questions, guys. I'm really sorry about that because it's also a free seminar. So I just want to make sure that we finish. And if we do get more free time at the end, you know, we can talk about some other questions. This is another motive wave. As I said, you only have motive wave and corrective wave. Motive wave is always 5 waves, very simple. But there is a variation of 5 waves. This is called impulse with extension, which is pretty simple. The extension can be in the wave 1, can be in the wave 3, and can be in the wave 5. So you should see here, by far the most common is this extension here, 1, 2, 3, 4, 5 in the wave 3. So wave 3 is subdivided into, you know, another 5 waves here. So you see how it is extended in the wave 3. By far this is the most common. Sometimes it can be extended in the wave 1. Sometimes it can be extended in the wave 5. Right? But all of them still suggest 1, 2, 3, 4, 5. And extension is elongated impulse with exaggerated subdivision. Extension happens in one of the impulse wave, subwaves, either in wave 1, wave 3, or wave 5. Extension frequently happens in the 3rd wave. So this is the most common one. Not really that, because the wave C in the EPC, it needs to be within 100 and 123.6% of wave A. Because if it is extended too much, then you start to suspect that it becomes 1, 2, 3. You notice here, for example, this is an impulse, right? Now, impulse and an ABC actually is similar. Look, an impulse with 1 is subdivided into 5 waves. With 3 is also subdivided into 5 waves, right? So if you only have 3 waves, and an ABC zigzag is also 5 waves, and the C leg is also 5 waves. Now, if you only have 3 waves, how do you know that you should label this as ABC or you should label this as 1, 2, 3? How do you know? If you want to label it yourself, and you're labeling market that is live market, and you see a 3-ways move, and then you check the internal subdivision is 5 here, first swing is 5 waves, third swing is 5 waves. This is also first swing is 5 waves, third swing is 5 waves. So how do you know whether this is an ABC or whether this is 1, 2, 3? Because the implication is if this is 1, 2, 3, you will have a 4 and 5. But if this is an ABC, you will not have another leg higher. In fact, you can even get, another leg lower if it is bearish in the higher degree time frame. If it is bearish, this could be just a correction, and then correction is over and then turns lower again. So how do you know that you should label it as ABC or 1, 2, 3? The only difference is whether you see an extension on the third swing. If the third swing extends to 1.618, then you should start to suspect this is becoming a 1, 2, 3. So let's say initially you think it's an ABC, but then you notice that this is extended, like what your question is. C is extended, right? It's subdivided into 5 waves, and then you notice here the relationship becomes 1, 2, 3. It becomes 161.8. Then instead of an ABC, you should start to suspect that this is actually an impulse. All right, you understand? You're welcome. All right, so this is impulse with extension. The relationship among the waves is very similar. With 3 should be the longest and all those things, and with 2 is 50%. So this is just a variation of an impulse, nothing different. It's just with extension. Now another variation is 5 waves, is leading diagonal. Leading diagonal is in the beginning of the move. In a 5 waves move, you see a 5 waves subdivision, but then instead of an impulse, you notice here how it is looking like a wedge, and then the subdivision here can be a 5, 3, 5, 3, 5, like this example, or it can be a 3, 3, 3, 3, 3. So this could be 3 waves, 3 waves, 3 waves, 3 waves, and so that's what we call leading diagonal. So in other words, you can even have a 3, 3, something like this, 3, 3 like this. But sort of the characteristic is this is appearing in a zigzag, an ABC, where you see a leading diagonal in the wave A. The characteristic is overlapping with 1 and the wave 4. That is the characteristic. If you remember, in the impulse, in the traditional impulse, the wave 4 cannot overlap with the wave 1, right? Cannot overlap, cannot touch the price territory of wave 1. But in a diagonal, it can, and usually it is overlapping. And then also the wedge shape, so it looks like a wedge. So this is called a leading diagonal, okay? Could be, usually happens in the wave 1 or happens in the wave A of an ABC. The divergence should be, well, depends on the move make. You got to have a sense to see what kind of move that is, whether it's a 15 minutes move, 1 hour move, 4 hour move, and so on. Now, if you suspect, if it is a short-term move, let's say 15 minutes move, if you look at the 4 hour, you will not see a divergence there, right? But you got to have a sense what sort of move is that, right? The way to have a sense is very simple. I mean, you just look at the chart, and then you notice here, for example, if this is a 1 hour, okay, if this is a 1 hour, I think this move qualifies for a 1 hour move, right? It qualifies for a 1 hour move, and that's why you see divergence here. So you got to have a sense a little bit. Let's say this move here, you suspect this is 5 waves. This is 1 hour chart. Now, if you try to see if you see a divergence in the 4 hour, you may not see it because this move here is too small for a 4 hour chart. Yes, we've got a code. Let me give you the code. A moment. Let me give you the code. So that's the link for you to look at. Oops, sorry. Not that one. Not that one. That's the link to go to the educational site, and then the code to join if you want to learn more is going to be so we got two different choices. One is classes. The class is individual classes. Okay, this is the code. This is a 30% off. And then another one is bundle package, which includes a mentoring 1-to-1. That will be 10% off. So that's the code. But the code is going to be also available at the end of the presentation. Okay, so if you can stay until the end, I will show it to you again later on. This is the code to learn more about our classes. All right, so if somebody is leaving and want to have the code quickly. Okay. Anyway, we're going to talk about it again later. So this is called the leading diagonal. Okay, so subdivision of the leading diagonal can be 5-3-5-3-5 or 3-3-3-3-3. Now, another variation is ending diagonal. It's the same, just like a leading diagonal, but the difference is it happens at the wave 5 of the impulse. So this is a 1, 2, 3, 4, 5 impulse, where the wave 5 you can see it's diagonal. Characteristic the same, overlapping with 4 to wave 1. Also a wedge shape here, right? The wedge shape. It can happen in the wave C of an APC as well from the ending diagonal. Okay, special type of wave, mostly appearing in the 5th wave. Also can appear in the wave C. Overlapping, wedge shape, usually found in the termination point of a larger pattern. Usually when you see a wave 5 with ending diagonal like this, usually it's at the end. Usually then you will see a big pullback afterwards. Each subwave is subdivided into 3. You can see 3, 3, 3, 3, 3. Now the same thing can happen as a leading diagonal as well. Leading diagonal can be 3, 3, 3, 3, 3 as well, even though in the example earlier we show it here 5, 3, 5, 3, 5. So only in the leading diagonal can have variation, but the ending diagonal is 3, 3, 3, 3, 3. Okay. Now we cannot talk about specific instrument, Joe, unfortunately. All right, because the seminar is really for like introduction. Yeah, you can. I mean, we offer trials. Okay, we offer trial, which is a 14-day trial. You can try our service, and I mean, if you want to try our service, you can try it with 14 days free trial. Let me give you. Let me give you the link. So that's the 14 days free trial. Okay, you can try it. We also offer, I mean, once you join as a trial members, you also get like a boot camp videos, 14 days boot camp where you will learn how to use our services and so on. Now, so enough about motive wave. It's basically 5 waves. Everybody understand there's a couple of variation, but all of them is 5 waves, either impulse, diagonal, okay, or I think that's it, impulse or diagonal. Now, corrective wave, on the other hand, has a lot more different structures. So for you to really understand Elliott wave, it is even more important for you to understand corrective waves than impulse, than motive wave. Okay, so this is sort of the easy one, zigzag. We looked at it earlier, an ABC. It is subdivided into 5, 3, 5, right? Corrective, 3 label as ABC. Subdivision of wave A and wave C is impulse because it's in 5 waves. Wave B can be any corrective structure. Zigzag is a 5, 3, 5. Now the relationship Fibonacci wise, with B is 50%, 61.8%. Most of the time, this is the typical relationship. With C, usually is 100% to 123.6% of the with A. And then if with C is 161.8%, it can be an impulse. We talked about it earlier. If you see this is extended, then you should start to suspect this is not an ABC, but this is a 1, 2, 3. Because when you only have 3 swings, right, the only way you know that this is an ABC or 1, 2, 3 is whether you see an extension in the third swing. If you see it's reaching 161.8, then you should start to suspect this is a 1, 2, 3, and then you will get a 4 and 5. Okay? Let's take a look at an example here with the zigzag. This is the Canadian dollar yen. Look here from this peak, we got 1, 2, 3, 4, 5, ending the with A. Okay, we got the with B, and then we got the with C, also 1, 2, 3, 4, 5. So we have an ABC here. And notice here, with B is around, it's a retracement, right? So it cannot go past above the beginning of the with A. And then you can see in the with C, ABC, the relationship in the extension is 80% of the time is between 100% and 123.6%. You notice here 100% is 85.6, 123.6% is 85, right? So it ends at 85 and then starts to bounce. So this is called a zigzag. So for example, we bought it here last time in the live trading room because we know this is a, an ABC, and we try to buy it here at 85. So we use this kind of technique, but then it doesn't mean that if we are showing that this is going to go higher, you can buy it. Still needs to have specific trading system and also trading with the trend, all those things to know whether you can trade it or not. But that's how we use the Fibonacci extension to help us to know approximately what kind of target we can expect on the move. Now, speaking about ending diagonal, this is the DAX. Now, this is a typical 1, 2, 3, 4, 5. Very nice. Remember, the different degree is labeled in a different color, right? Remember the Elliott wave degree, right? So this is a 5 waves move from here. This is a 4-hour chart, 1, 2, 3, 4, 5. And you notice here the wave 3 is the longest one. And you notice the subdivision here, 1, 2 in the lower degree, in the minor, in the red color, 1, 2, 3, 4. And then you see what looks to be an ending diagonal here in the wave 5, right? You see 1, 2, 3, 4, 5. Now, if you want to subdivide it in the ending diagonal here, so this is 1, 2, 3, 4, 5, looking like a wedge, right? So that's an example of an ending diagonal. This is also an example where you get extension in the wave 3 because you see it's extended, right? Also, you see a triangle here. We're going to take a look at triangle next. This is usually triangle happens in the wave 4. This is very good example of triangle here. So it's very, very nice example here. A typical example of an extended wave 3. We get ending diagonal, we get triangle, and so on. Yeah, we're gonna upload it in the YouTube maybe. Yeah, we usually do. Just send me an email if you don't see anything. We're gonna post it afterwards, okay? All right, now next corrective structure is called flat. Flat is also labeled as an ABC, okay? Same as zigzag, but the difference is you notice here the subdivision is 3, 3, 5, 3, 3, 5, 3, 3, 5. There are 3 different types of flats: a regular flat, expanded flat, and running flat. Think about a flat of a sideways move. Think about a flat as a sideways move, right? Unlike a zigzag, which is a clear ABC lower low, you can see how messy a flat is. You see here it breaks above the beginning of wave A and the wave B, and then wave C breaks below the wave A, right? But it is also labeled as ABC. The difference is the subdivision of wave A in the flat is in 3 waves. In a zigzag, it is in 5, 5, 3, 5. But flat is 3, 3, 5, 3, 3, 5. Okay, so 3 different types of flats here. Okay, so regular flat, an ABC. The rules is in 3 waves, wave A and wave B, right? Subdivision of wave C is in 5 waves. Wave B terminates near the start of wave A, just like this. Wave C generally terminates slightly beyond the end of wave A. Wave C must have momentum divergence, RSI divergence. The Fibonacci relationship with B is 50, 61.8, 76.4, 85.4% of wave A, because it terminates near the end of wave A. Sorry, terminates near the start of wave A, so it's usually not passing beyond. Now wave C usually is slightly beyond the end of wave A, so usually is between 100% to 123.6% of this A and B. Expanded flat, on the other hand, is another variation of flat. The difference is just on the wave B terminates beyond. So expanded, the wave B terminates beyond the starting level, and wave C ends substantially beyond the ending level of wave A. But otherwise, everything is the same, 335, momentum divergence. The Fibonacci is slightly different with B because it terminates above it, beyond the starting point of the wave A, so usually 123.6% of wave A. Wave C usually is 123.6% to 161.8% of wave A and B. We're going to take a look at an example of this, so don't worry about it. Running flat, the same idea, but slightly different variation. Wave B terminates substantially beyond the starting level of wave A, but wave C fails to falling short of the level of wave A. So you can see the wave C does not go beyond the end of wave A, unlike the expanded flat. It sort of fails, and then so it's also 335. Okay, so the Fibonacci relationship with B is 123.6% because it goes more than the starting point of wave A, and wave C is around 61.8% to 100% of wave AB. Okay, let's take a look at an example of a running of a flat. Now you notice here Aussie dollar, New Zealand dollars in the monthly time frame. So you notice here from here. Now this is debatable where you want to get the A and B, but I'm just gonna show it to you this one. Do you see how this is sideways, right? Sideways move, right? Compare this to this expanded flat here, A, B, C. You see like an A, B, C, right? And then you notice the C is also in 5 waves. Very clear, 1, 2, 3, 4, 5. So this is an example of an expanded flat with B beyond with A, beyond the starting point of wave A, and then with C is in 5 waves. And then looking at the Fibonacci relation, you notice here it ends at 123.6. In other words, this C leg is 123.6 extension of the A leg. Okay. Another example, all of you should be familiar, is SPX. SPX. Now this is the monthly chart. You notice, you guys, if you trade long enough, you remember the dot-com bubble. You remember the Lehman Brothers. Everybody remember? Everybody traded already at that time. You see a plunge in the market over there. a lot of people are scared of this. Now this is also a flat. You notice here? A, B, C. If I go to the lower time frame, this is monthly. If I go to the weekly, let me erase this. Now you notice very, very clear. 1, 2, 3. So this is with 1, with 2, with 3, with 4, with 5. You guys see it? Very clear. That's the Lehman Brothers collapse. An A, B, C leg is a 3, 3, 5. In a flat, usually in the C leg feels very, very strong, scare everybody off because it's 5 waves. It's usually typical of a flat. The C leg always scares people off. All right, triangle. Now the next one, we have many different types of triangle. You don't need to understand all of this, to be honest. All you need to know is this is sort of like a consolidation, right? I mean, all of them looks the same anyway, just slightly different variation. So we have in the bullish market what's called ascending, descending, symmetrical triangle, expanding triangle. But it is labeled as an ABCDE. It's nothing more than a sideways consolidation, regardless how it looks like. Okay? So very simple, the rules. This is corrective structure labeled as ABCDE. Usually happens in the wave B of an ABC or in the wave 4 of a 1, 2, 3, 4, 5. Subdivided into 3, 3, 3, 3, 3. Like the subdivision is all in 3, 3, 3, 3, 3. The RSI also needs to support the triangle. Okay, we're going to take a look at this, what this means. And then the subdivision of the ABCDE can be either ABC. So this can be an ABC, right? Because it's 3 waves. This could be a zigzag or it could be a flat. We already talked about flat, right? So this could be a flat. This could be a zigzag, or this could be a WXY. We haven't talked about WXY. We're going to talk about it next. But the subdivision can be any corrective structures. Can be ABC. Zigzag can be a flat, can be WXY. Okay, so now let's take a look here with example of a triangle. Now we take a look earlier with the DAX. You notice here wave 4 is a triangle. Now if I go to the lower time frame now, this is the wave 4 in the DAX. Okay, so you notice here wave A is in 3 waves, wave B is in 3 waves, wave C is in 3 waves, and so on. Right? So A, B, C, D, E. And then we got the wave 5. So usually after triangle, especially in the wave 4, we have terminal thrust on the upside. So we got another impulse up to finish the wave 5 in the DAX. You notice here in the RSI, how the RSI also confirms the shape of the triangle, right? So the RSI also needs to confirm the shape of the triangle to get a better quality triangle. Now if the RSI does not, for example, if the wave B spike up, break above this, then the RSI means the shape of the RSI does not conform the shape of the triangle, then you will get more chances to be wrong to label it as a triangle. Okay, so that's what we mean earlier by saying RSI also needs to support the triangle. Double 3. So this is very, very common, guys, double 3. Okay, now you got to pay attention to this because this is probably the most important out of all the structures. Okay, and also the most confusing. Now double 3, what does double 3 mean? It's a combination of 2 corrective structures labeled as WXY. So forget about WXY. We already learned a bunch of corrective waves, right? Can you name it if you guys remember? There's not really that many corrective waves. We learned about zigzag, we learn about flat, and then what else? We learn about triangle. That's it, right? Only 3, right? That's all you need to remember. Zigzag, flat, triangle. All right? So what is a WXY? Double 3. This is nothing more than a combination of 2 corrective structures that we already know. And then we combine them using a WXY as the connectors. So the width W and the width Y can be any corrective structure. So in this case, take a look at this. This WXY in the red in the minor degree. You notice on the left side, what is this? What is this structure here, guys? This is a flat, right? You have 3, 3, 5, sideways, expanded flat. On the right side, what do we have? We have 5, 3, 5. So we have a zigzag ABC. So you have 2 corrective structures. You combine them together, right? In this case, you have a flat and you have a zigzag. You combine them together and you put a WXY as the connectors. You guys understand? Double 3. So it's a combination of 2 corrective structures. And we learned about corrective structures already. We learned about zigzag, flat, and so on, right? And the Fibonacci relationship here, the width X is, because it is a retracement, is around 50%, 61.8%, and so on of the width W. The width Y is 61.8%, 100%, 123.6% of the width W. And the width Y does not pass 161.8% of the width W. Okay, let's take a look at an example of a WXY. Here is the pound US dollars 1 hour chart. Okay, so you see this one here, W. From this peak, we have a WXY. Very simple, right? 3 waves down. 3 waves down. And look at the Fibonacci relationship. Very simple. This is a correction, so it's around 50%, 61.8% of this W here. And then the Y should be about 100% of the W. So you notice here it ends between 100% and 123.6%, the Y. Okay, and now you notice here the W in black. Okay, I think this is a minuet degree. Okay, you notice here what is the subdivision here? This is a zigzag, right? An ABC. And how about this one, the Y? The Y is subdivided into another WXY. All right, so we have a zigzag on the left and another WXY of the lower degree on the right, and we connect them with a WXY in the higher degree label, which is the black degree. So again, understanding Elliott Wave degree is the key. Okay, guys, like I said, you got to understand the Elliott Wave degree to understand how to read this chart. Otherwise, you will be confused how to exactly read the chart, right? So understanding the different degree is going to help you out. Here's another double 3 example. Okay, same exact rules, same exact relationship, but this is a flat here combined with a triangle, right? So we have a flat on the left side, we have a triangle on the right side, and we connect them with a WXY. So again, WXY is a combination of 2 corrective structures. Here's another example. It is another double 3. On the left side, we have another double 3. So you see, we have a WXY, but on the left side, the subdivision is another WXY of the lower degree. Right? If the red degree is minor, then this is the minute degree. So we have another 3, 3, 3. So you can call a WXY as a 333 if you want to. It's a 333 because if this is a 535, then you don't label it as a WXY. You label it as an ABC, zigzag. But if the subdivision you see is only 333, then you label this as a WXY. Okay, so on the left side we have another double 3. On the right side you have another double 3. You combine them, we have a WXY of the larger degree. Triple 3 is nothing more. I mean, if you understand double 3, you will have no problems with triple 3 because triple 3 is just a combination of 3 corrective structures, and we label them, we connect them with WXY, X, Z. All right, so before is WXY, now we put X and Z. So here is an example. We have a flat here, ABC flat, and then in the middle we have a double 3, another WXY. On the right side here we have ABC zigzag. So this is a combination of flat, double 3, 6. It can be any combination of 3 corrective structures, right? So it's very simple. Here's another example. This is a combination. All of them is a double 3. This is very common, by the way, in the market. So we have double 3 here, double 3 here, and double 3 here, and you combine them and become a WXYXZ, right? Now, in the market nowadays, the most common structure is this. This is the most common structure, WXY, where the subdivision is also itself another WXY of the lesser degree. With 3, Eric, with 4 cannot retrace more than 50% of with 3. Okay, and also cannot overlap with 1. You're welcome. Everybody clear about double 3, guys, or still confusing? Double 3 to triple 3 is the most difficult in Elliott Wave. If you understand double 3, triple 3, you understand everything. But it is a combination of corrective structures, and there's pretty much only 3 corrective structures, right? Zigzag, flat, and triangle. That's it. Only 3. And then you combine, mix and match, combine it with a WXY. Right? Let me see if I miss any example. I think expanded flat. Yeah, I think I show you all the example. Now let me end today's webinar by telling you now, if you are interested to learn more, now again, this is a free webinar, introduction to beginner level. We got a bunch of educational classes. Okay, we have 4 educational classes. This is learning Elliott Wave, is talking about what we are talking now, but on top of that, it teaches you a lot more, like teaching you about how to trade in 3711 swing, touching about that aspect, also teaching you about psychology, teaching you about RSI, stochastic RSI, how to use it, how to apply it. So that is the learning Elliott Wave. This is an 18-hour class. This is by far is the most the most basic classes that we have in Elliott Wave. Again, with the coupon, you can get 30% off if you buy the class. Okay, this is the coupon code. If you go to our website, I think the link I give it to you. Then if you use this coupon code, valid until 28 February, you can get 30% off. Okay, and this EW structures and swing sequence, this one is the actual trading system that we have. So again, like I always say, you understand Elliott Wave, great. That is sort of the requirement before you trade. You understand how to read Elliott Wave, but that doesn't mean you know how to trade it. Now this one is combining what you know about Elliott Wave, right, and then apply this trading system called the 3711 swing to identify potential trades. So this is really explaining exactly how the trading system works. This is 4 to 5 hour class, $100, and then you can also get 30% off. The trading execution seminar, the third class we have, is 5-hour class. This is teaching you how to exactly execute a trade, where to enter, where in the stop you should place, okay, and how to open the right position size and manage your risk. So that will be trading execution seminar. So this also sort of, if you understand this, then it will be making sense for you to do this, because then you will know, okay, why do I need to enter at that area and so on. It will be explained in these classes here. This execution is telling you where you should put the stop exactly. This is sort of the explanation of the basis of the system, and this is the actual way to trade it. And this is the latest class we have, new Elliott Wave correlation trading execution. We talk more about correlation here. We talk about Elliott Wave and also some of the topics here. And this is the newest one, so it has some of the newest findings we have that is not included in these classes. It's a 5 to 6 hour class here. All right. Yeah, this is the same as the one. If you have it already, Andrew, then it's the same. It's the same class. Let me see here again. You can go to the educational website that we have. This is the link, and sorry, and if you go to our website, this educational here, elliottwave-forecast.com educational. There's an educational products here, right? This is the bundles on the package, including one-to-one mentorship. But if you only want the class, then you should click services here. Then you will have these classes that we talked about earlier. Otherwise, the package is a bundles where you get a bunch of classes together. It will be cheaper, relatively speaking. But then on top of that, you will get, one-to-one mentoring with one of our analysts, okay, to help you out with some of the questions you have or some of things that you want to clarify. All right. So for the classes, you can get 30% off, but for the bundles with the one-to-one hours, this coupon code is 10% off because it includes man hours. Okay, so it includes one of our analysts actually is talking with you directly, so we cannot get a lot of discount off out of this package here. But this is explanation. We have Platinum, Premium Plus, Premium Educational Package, and so on, one-to-one training, and this is. So these are bundles. You get all 4 educational class plus 10 hours of one-to-one mentorship. Premium Plus you get 2 educational classes, which is these 2 classes and 6 hours and so on. All right, so 4 additional thing that if you want to learn more. Okay, guys, so I think I finished. Let me see if I can get any other question. Yeah, the code, if you buy it here, let's say you want to buy the package here, let's say you want to buy the premium package, you enter the coupon here, David, and then you will get that discount. All right. So there's a coupon code box here. The 3711, no, we do not cover the 3711 for today's webinar because that is the actual rating system, and we only teach that to the members. Okay, guys, any question, guys, before we end about anything that we talk about today? You're welcome, Mick. So I hope that it helps you a little bit to understand some of the basic structures. Really not really that complicated if you think about it. You only need to remember motive wave, which is 5 waves, corrective waves, which is 3 waves, and you only have 3, right? You only have zigzag, flat, and triangle. And then the double 3 and triple 3 is nothing more than you combine them together. And then the most important thing eventually is going to be how to read the charts and how to understand the different degrees, which is this table here. Very important. Other than that, it's kind of easy. The webinar is going to be recorded. I'm going to post it at the website, in our website, when it is done. We're going to upload it in the YouTube as well. Okay, so usually you will see here in our website, in the video here. I mean, after a while it's going to be gone because we keep posting new videos every now and then. So you might want to, if you find it, you might want to sort of bookmark it if you want to review it in the future, right? Otherwise, we also will upload it in the YouTube as well. Depends, Feroz, how much time it takes, right? It depends on your commitment, your background, right? It really depends. It depends on your commitment, how much time you invest on it. It's a good question. No, I would say it's different for different people, right? How much time it will take to master Elliott Wave and start trading. Now, like I said, knowing Elliott Wave is just one component of a comprehensive trading system. Knowing Elliott Wave, and then these three aspects you need to understand as well: the risk management aspect, the execution aspect, and the cycle sequence correlation aspect, right? So this is sort of one of the basic building blocks. Elliott Wave only is not enough for you to trade. You need to apply specific trading systems with specific rules telling you specifically where you enter, where your stop loss is, where your target is, and whether you can take the trade or not. That will be the execution part, which is our trading system based on the 3711 swing. So the Elliott Wave chart is only one aspect that is giving you the map. And then from there, you need to identify again, okay, whether you can trade it or not. So for example, let me show you an example here. So we do have a lot of charts of the day, for example. Let's say this is our chart of the day, oil. Now when we show you only one chart, which is the 1 hour chart, and we are showing this, that doesn't mean I can start selling this, I can start buying this, I can start selling this, I can start buying. That doesn't mean that way, right? You still need to have specific rules, specific system that gives you the rules exactly if you can enter the trade and whether you should sell or you should buy. All right, guys, so that's the webinar for today, guys. Thank you very much for joining, guys, and we'll try to do this kind of webinar every now and then. So hopefully see you guys again next time. All right, guys, bye everyone. You're welcome.